Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another deep exploration.
Great to be back.
Today, we're taking a magnifying glass to a company that's been around for, well, over a century. A true titan of technology. International Business Machines, or IBM.
Big Blue.
Exactly. For many, IBM might conjure images of mainframes, maybe pinstripe suits, a legacy tech giant. But what we're going to unpack today is a company that's undergone and is still undergoing a really profound strategic transformation, kind of under the radar for a lot of people.
Yeah, it's been happening for a while now.
The central intriguing question for this deep dive and what we're here to figure out for you is this. Has IBM, after years of significant, often pretty painful change, successfully rebuilt a truly durable competitive fortress? Is it on its way to becoming what we'd consider a wonderful company, something you could hold for decades in a long-term portfolio? Or are there still hidden challenges the market might be overlooking in its current assessment?
That's a massive and, a really critical question. It's one that often comes up, actually. This company has such a fascinating, complex history, but its future really hinges entirely on how effectively it's repositioned itself for, the modern tech landscape.
Right.
Our journey through this analysis today, it's going to distill what could be incredibly complex stuff. Business models, economic moats, tricky financials into clear, actionable insights for you, helping you understand not just the facts, but what they really mean for IBM's long-term prospects as an investment.
Perfect. And just a quick note for you, our listener, if you find value in this kind of in-depth discussion and the insights we uncover, the best way to let us know and, ensure you catch our next deep dive is to subscribe and like. It truly helps this channel reach more curious minds.
It really does.
And if you have any questions as we unpack this, you can always share your thoughts and perspectives. We love hearing from you.
Absolutely. Now let's get right into it. We'll begin by truly understanding the core of IBM, its evolving business model, and the competitive fortress it aims to build around itself.
Okay, let's unpack this business model then. When we talk about IBM today, it's crucial to understand it not as just a collection of separate parts, but as a deeply integrated technology and consulting enterprise.
That integration is key.
Yeah, it's not just selling one thing or another. Its core identity is about providing end-to-end solutions, primarily for the largest, most complex organizations globally. Think Fortune 500, governments, major banks.
The big players.
Exactly. And their sharp focus now is squarely on these high-growth areas, hybrid cloud and artificial intelligence. They essentially operate through three core synergistic segments that really drive their revenue and profits: software, consulting, and infrastructure.
And that integration you mentioned, that is absolutely key. It's where so much of IBM's unique value proposition lies. If we dive into the software segment first, this is truly the primary economic engine for the company right now.
Right.
It consistently accounts for roughly 43% of their total revenue, but an even more impressive 61% of their gross profit, often with gross margins exceeding 80%.
Wow, okay, 80% plus.
Yeah. And this isn't a one-off sale business. The revenue here is predominantly recurring. It comes in through sticky subscriptions, long-term licensing deals. Their offerings are incredibly diverse within this segment, too.
Like what?
Well, you've got the Red Hat hybrid cloud platform that's a foundational operating layer for modern applications. Think of it like, air traffic control for software, managing where apps land and how they talk across different cloud environments.
Okay.
Then there's their automation software, and crucially, their data and AI platforms, specifically the WatsonX suite. That's IBM's unified platform for building, training, and scaling AI models across an enterprise.
WatsonX, right. Heard a lot about that.
And let's not forget the mission-critical transaction processing software. That stuff still powers mainframes for some of the world's most demanding computing environments. So, the continued growth in the software segment. It's arguably the single most important driver for IBM's future profitability because of those incredibly high margins.
Absolutely. It's where they're aiming for the most leverage and, future growth. And then, acting as a powerful counterpart, you have the consulting segment. This is their people power division.
The services arm?
Right. Represents around 32% of revenue, about 15% of gross profit. Now, its strategic role is fascinating because it serves as this powerful pull-through mechanism.
Pull-through.
Yeah, think of it as the tip of the spear. It doesn't just provide expert advice. It actively drives enterprise-wide adoption of IBM's own software and infrastructure solutions. It's not just recommending stuff, it's leading clients directly to IBM's products.
So consulting feeds the software and hardware sales.
Exactly. And what's also really important here is their partner ecosystem. Strategic alliances with major players like Microsoft, SAP, Salesforce, these now contribute to over 40% of this segment's revenue, which is, a very smart way to expand their reach and influence without having to build every single piece themselves.
That makes sense. And tying it all together is the infrastructure segment. This is the historic bedrock of IBM, right? Accounting for about 24% of revenue and a similar share of gross profit.
The mainframes and servers.
Exactly. It's where they sell the high-performance hardware, like the IBM Z mainframe systems.
So it's not just three separate businesses operating independently. It's this incredibly integrated nature, what we call IBM's flywheel effect, that's truly crucial and, frankly, often overlooked by the market.
Yeah, the synergy is huge.
It's a self-reinforcing ecosystem. The 2024 annual report actually highlighted that approximately 80% of IBM's revenue comes from clients purchasing solutions across all three segments.
80%.
Yeah. To give you a concrete example, the consulting arm fuels about 80% of the company's AI bookings. Those bookings are then realized through the software and infrastructure segments. So you have consulting uncovering complex client needs. Those needs are then addressed by IBM's proprietary software like WatsonX or Red Hat, and that software, in turn, often runs best on its optimized infrastructure. This integrated value prop is a key differentiator that the market frequently misses when it tries to do a simple sum-of-the-parts valuation.
They're just looking at the pieces, not how they fit together.
Exactly. They're looking at individual gears, not the powerful engine those gears form together.
And we can see this powerful synergy reflected directly in their financials for fiscal year 2024. The software segment, like we said, is the powerhouse. $27.1 billion in revenue, impressive 9.0% year-over-year growth in constant currency, pulling in $22.7 billion in gross profit. That's at a remarkable gross margin of over 80%.
Just incredible margins there.
Yeah. Consulting, meanwhile, brought in $20.7 billion in revenue, slight growth at 0.6% constant currency, $5.6 billion in gross profit, showing a healthy 27.0% margin there. Still good.
Respectable for consulting.
And the infrastructure segment, $14.8 billion in revenue, saw a slight decline, 2.7% in constant currency, but still generated $7.8 billion in gross profit at a strong 55.8% margin.
Still very profitable.
Absolutely. Overall, the company's total revenue hit $62.8 billion for 2024, with 3.0% constant currency growth and a robust total gross profit of $36.3 billion. That's a 57.8% overall gross margin. These numbers really underscore that strategic shift towards higher margin software and the enduring importance of that mission-critical infrastructure.
Okay, so here's where it gets really interesting, thinking about the simplicity and endurance of this model. The fundamental logic is incredibly intelligible, and we believe highly durable. At its core, IBM provides the essential computing backbone, the infrastructure, the critical software that runs on it, and the expert services to integrate and manage it all for global enterprise. This model's endurance over the next, say, 1 to 2 decades appears highly probable. It's anchored in these powerful structural trends and, frankly, predictable human behavior.
Precisely. And it's not about public cloud abandonment. That's a common misconception you hear.
Right. People think it's one or the other.
Yeah, but it's about the integration into a cohesive hybrid cloud architecture. This isn't some far-off vision. It's the current reality for large organizations. Data actually shows that nearly 80% of IT decision makers are already operating hybrid cloud environments.
Are they there?
Yeah. And think about IBM's target clientele. Large, regulated, risk-averse institutions, banks, healthcare, government. They are simply not going to fully entrust their most sensitive mission-critical workloads entirely to a third-party public cloud. It doesn't matter how much cost savings are promised.
Too much risk.
Exactly. Human behavior dictates a preference for trusted, established partners for these core systems, a role IBM has fulfilled for, over a century. So the strategic pivot under CEO Arvind Krishna isn't really a radical departure. It's more like a shrewd modernization of an enduring model, positioning IBM to be the indispensable platform for this next generation of enterprise IT, recognizing the world will be hybrid.
Okay, so what does this all mean for their competitive advantage? Let's talk about their economic moat, their competitive fortress.
Yeah.
IBM's primary and, I think, most formidable economic moat is built squarely on high switching cost. This isn't about fleeting product features that can be copied or some simple SaaS app you can swap out tomorrow. This is about the deep systemic integration of IBM's tech and services into the core operational fabric of its enterprise clients.
It's embedded.
Deeply embedded. These are the digital equivalent of a building's foundation or a city's power grid. You just don't rip them out without massive consequence.
And the costs of switching are multifaceted, truly daunting for these massive organizations. You're talking immense direct financial outlays, huge operational risk, the very real threat of catastrophic downtime.
Nightmare scenario.
Oh, yeah. Plus the incredibly complex process of migrating potentially decades of data and needing to retrain thousands of employees on totally new systems. And this moat is further fortified by powerful intangible assets. You've got that century-old brand synonymous with enterprise-grade reliability and security.
Trust factor.
Huge trust factor. And one of the world's largest and most valuable patent portfolios, which acts as both a deterrent to competitors and a source of licensing revenue.
Can you give us a concrete example of this moat in action?
Sure. Let's look at the role of the IBM Z mainframe in the global financial system. It's estimated that an astounding 96 of the world's top 100 banks rely on IBM mainframes for their core transactions.
96 out of 100. That's dominance.
It really is. Think about a payments giant like Visa. They've leveraged IBM mainframes to achieve 100% system availability over the past 20 years.
20 years, 100%.
Yep. Through every peak holiday shopping season, global crises, without a single instance of downtime. It really makes you appreciate just how critical these systems are.
Yeah, for some companies, pulling out an IBM mainframe is probably like trying to change your car's engine while driving down the highway. It's just not feasible.
Exactly. For an institution like Visa or any major bank, the prospect of migrating its core transaction processing system, the very heart of its business, to an entirely new architecture. It's not just a technical challenge, it's an existential risk.
Right.
The potential for data corruption, security breaches, or catastrophic system failure during such a transition would far outweigh any theoretical cost savings from a competitor. This deeply ingrained fear, uncertainty, and doubt, the FUD factor, associated with replacing a proven mission-critical system actively repels competitors and grants IBM significant pricing power over the whole ecosystem, hardware, software, services. It's an almost unassailable position for those specific, highly critical workloads.
Okay, so the moat is strong. Now let's consider its trajectory. Stable, widening, shrinking.
Yeah.
How do you see it?
We assess it as stable, with a clear potential to widen in the coming years.
Okay. Why stable?
The stability comes from the enduring stickiness of its core mainframe business. The fact that the Z16 program is the most successful in the company's history is powerful evidence that the platform's value proposition for those mission-critical workloads remains entirely intact. That forms a solid cash-generative foundation for the moat.
And the widening potential, where does that come from?
That stems directly from what we consider the company's strategic masterstroke, the $34 billion acquisition of Red Hat.
Huge deal.
Massive. This move was explicitly designed to extend IBM's moat from the on-premise data center into the hybrid cloud era. Red Hat OpenShift is being aggressively positioned as the de facto standard for container orchestration.
Explain container orchestration quickly.
Sure. It's essentially a consistent software layer that allows applications to be built once and then run anywhere, whether that's on an on-prem IBM mainframe, a private cloud, or even a public cloud from competitors like AWS and Azure. It's like creating a universal plug that fits into any outlet in the enterprise IT world.
Got it. So it connects everything.
Exactly. And here's where the strategic evolution is key. Historically, IBM's moat was hardware-centric, built around that proprietary mainframe box. The new strategy is much more platform-centric.
Right, shift from hardware to platform.
The goal is no longer just to lock customers into IBM hardware, but to lock them into the IBM-owned platform that manages and connects their entire IT estate. By providing this essential connective tissue for the hybrid world, IBM is embedding itself even more deeply into its customers' core architecture, thereby raising switching costs for the next generation of enterprise applications.
So the success of this strategy and the moat widening really hinges on Red Hat OpenShift achieving that dominant market position.
Absolutely. Its adoption rate is the single most important metric for gauging how much that moat is truly widening.
Okay, let's connect this to some broader mental models. IBM's business structure seems like a textbook illustration of Warren Buffett's concept of an economic castle protected by unreachable moats.
It really does. The castle here is IBM's highly profitable core enterprise business, especially that software segment generating substantial recurring revenue and free cash flow. That's the value the business protects and grows.
And the moat, what makes it so formidable, are those deep and wide high switching costs we talked about. Trying to rip out an IBM mainframe from a global bank or replace a deeply integrated Red Hat OpenShift platform. It's like trying to replace the foundation of a medieval castle while it's under siege.
Yeah, fraught with peril, enormously expensive, and profoundly disruptive to the client's core operations. The Red Hat acquisition, as we discussed, can be seen as a strategic project to dredge this moat deeper and extend its perimeter into those new lands of the hybrid cloud, ensuring its relevance for decades. And what's fascinating here is how IBM's integrated model exemplifies Charlie Munger's Lollapalooza effect.
Ah, the Lollapalooza effect. Explain that.
It's where multiple factors combine and act together to produce a result that's much bigger than the sum of the parts. A nonlinear, overwhelmingly powerful outcome. IBM's individual components are strong, sure, but their combination is truly formidable.
So what are the combining factors here?
You've got the confluence of mission-critical hardware with that unparalleled reputation for security and reliability, things like they're a Telum 2 processor, engineered for demanding transactions. Then, sticky, high-margin software like Red Hat and WatsonX optimized to run on that hardware and across hybrid clouds. Add in the deep industry and technical expertise from consulting, designing, implementing, managing these complex solutions. And finally, layer on that century-old brand, providing the institutional confidence needed for these huge tech investments.
Okay, so those four things interacting.
Right. This is where the synergy truly comes alive. These elements don't just add, they multiply their strengths. Consulting proposals are more credible because they can deploy a full stack of proprietary tech.
Makes sense.
The software's value is enhanced when running on optimized IBM hardware, and the hardware sale itself is made easier by the brand's long-standing reputation. This powerful synergy creates a competitive position that's far more resilient than any of its specialized pure-play competitors can achieve individually.
It's the whole being greater than the sum of its parts, and that's why IBM can tackle those massive, complex enterprise deals.
Exactly. Now, to get a feel for the company beyond the numbers, we also looked into customer and employee perspectives. You know, the scuttlebutt.
Right. What are people actually saying?
On the customer side, the sentiment is generally one of professional appreciation for powerful, reliable, enterprise-grade tools. It's not love like you get with consumer brands.
No one's getting an IBM tattoo.
Probably not. But there's deep respect for capabilities, though sometimes tempered by complexity and cost. For instance, IBM Cloud gets a solid 4.5 out of 5 from Gartner reviewers, consistently praised for exceptional performance, reliability. One user reported over 4 years with no major issues, no P1 issues, and no outages.
It's impressive.
It is. However, you also hear critiques about higher costs compared to some public cloud alternatives, a console that can be complex or slow to navigate, and support times that, while good for critical issues, can sometimes lag for less urgent stuff.
Okay. What about their AI platform, WatsonX?
Sentiment there is similarly positive. Strong ratings on G2, Gartner. Users commend its ease of use for building models, the wide variety of models available, its scalability. We've seen real business value, too. Camping World boosted agent productivity by 33%. Vodafone dramatically cut testing timelines using WatsonX.
Tangible results.
Definitely. But again, common drawbacks cited are a steep learning curve to master the whole platform, high costs when you scale up, and an initially overwhelming user experience because it offers so much.
Right. It's powerful but complex. Now, what about the employees? What's the view from inside?
The employee perspective. It's really a dichotomy, quite fascinating. On one hand, many employees genuinely value the good work-life balance, remote work flexibility, competitive pay, and, of course, the prestige of having IBM on the resume.
Still a respected name.
Very much so. They often report working with highly skilled colleagues, a pro-learning environment, and appreciate the autonomy they get in their roles.
Okay, sounds pretty good. What's the other side?
Well, the other side involves significant and quite vocal frustration with a culture they perceive as bureaucratic and slow-moving, especially when trying to push new things through.
The big company problem.
Exactly. And the most common complaints, which are serious, revolve around the constant threat of layoffs, often called resource actions. This has unfortunately eroded morale and, trust in upper management for some.
That's tough.
Yeah. This culture lag is a critical non-financial risk. A successful strategic pivot needs a cultural transformation to match the tech ambitions. If IBM can't consistently attract, motivate, and retain the elite talent needed for AI and cloud, its long-term strategy execution could be compromised. Doesn't matter how brilliant the plan is on paper if you don't have the right people fired up to execute it.
That's a really crucial point. So moving to the competitive landscape, who are they up against?
It really breaks down into two main categories of rivals, each with different strengths. First, you've got the hyperscale cloud providers, think Microsoft Azure and Amazon AWS primarily.
The giants.
The giants. Second, there are the pure-play IT consulting and services firms, with Accenture being a prime example.
Okay, and how do their strategies differ from IBM's?
Very distinct. Microsoft and AWS dominate public cloud. They leverage immense scale for cost reduction, offer vast infrastructure as a service, basically virtual computing power, and platform as a service, pace the environment, to build and run apps. Their whole narrative is centered on pure public cloud superiority, trying to pull clients fully into their ecosystems.
I move everything to our cloud.
Pretty much. Accenture, on the other hand, positions itself as technology agnostic. They're the strategic partner providing consulting and implementation expertise to integrate best-of-breed solutions from various vendors. Their product is really human expertise and orchestrating different technologies.
Got it. So where does IBM's durable advantage lie against these players?
IBM's key durable advantage lies in its unique, really unmatched ability to deliver a fully integrated, enterprise-grade hybrid cloud solution, spanning the entire tech stack from the silicon chip right up to the consulting services. The whole package.
The whole package. What's fascinating is its differentiation versus the hyperscalers. IBM doesn't preach a public cloud-only doctrine. It explicitly embraces the complex reality of large enterprises who, for security, compliance, performance reasons, will continue operating critical systems on-premise.
They meet clients where they are.
Exactly. Its hybrid strategy, powered by Red Hat, offers a bridge, a consistent operating environment, not a forced migration. That's a powerful differentiator for its core clientele.
Okay, and versus the consultants like Accenture.
Well, unlike Accenture, IBM is not technology agnostic. It possesses that deep proprietary tech portfolio from its own mainframe processors like the Telum-Toucan to the WatsonX AI platform. This allows it to offer an optimized end-to-end solution that a pure-play consultant who has to stitch together third-party parts just can't replicate with the same seamless integration and performance guarantee.
That integration is the key differentiator again.
It truly is. That seamless blend of technology and expertise is the foundation of its competitive fortress in the enterprise world. All right. Let's move on to the next critical pillar, management, stewardship, and financial resilience. This is where we look at the quality of the leadership and the strength of the balance sheet.
Absolutely crucial elements.
Let's start with the CEO, Arvind Krishna. He's been leading since April 2020. His leadership seems defined by a really clear, consistent philosophy. Focus IBM's vast resources on those two big shifts, hybrid cloud and AI.
Laser focus.
Yeah. His public statements, shareholder letters, they consistently reveal a deeply long-term, kind of owner-oriented mindset. He emphasizes durable client value above everything else. You see this through his unwavering focus on solving complex client problems, his disciplined approach to portfolio management, getting rid of non-core assets.
Like spinning off Kyndryl.
Exactly. Okay. And his emphasis on responsible tech stewardship, especially with AI.
Yeah, there was a quote from a recent shareholder letter that really captured this, something like, "We are ready to be the catalyst of progress for our clients as they pursue the digital transformation of the world's mission-critical businesses." That language, it prioritizes client success as the source of sustainable shareholder value.
Right. If the clients succeed, IBM succeeds.
Precisely. And his actions back this up. Decisive moves like the Kyndryl spinoff, the strategic acquisitions of Red Hat, and others like HashiCorp recently, all designed to reposition IBM as a higher growth, higher margin enterprise. He's basically been pruning the garden, focusing on the strongest, most fruitful plants.
Makes sense. What about management incentives? Are they aligned with shareholders? And do they have skin in the game?
Yeah, looking at the executive compensation structure at IBM, it appears remarkably well aligned with long-term value creation. The program explicitly links exec pay with shareholder interests by tying a significant chunk of compensation to multi-year performance metrics.
How does that work specifically?
Well, their annual incentive program, the AIP, is based on heading targets for revenue and operating cash flow. Pretty standard. But more importantly, the long-term incentive part, given as performance share units, PSUs, depends on 3-year performance against targets for revenue, operating EPS, and free cash flow.
Okay, those are key metrics.
They are. And crucially, it includes a relative return on invested capital, ROIC modifier. It compares IBM's ROIC performance against its peers, which really sharpens the alignment with shareholder value creation, ensures they're not just growing, but growing efficiently with the capital they employ.
And the skin in the game. Do executives own much stock?
They do have significant skin in the game. As of the end of fiscal 2024, CEO Arvind Krishna's holdings were valued at over $87 million. That's more than 42 times his base salary, comfortably exceeding the company's ownership requirements.
Okay, that's substantial.
Yeah. And the executive leadership team, as a group, held shares and equivalents valued at over $187 million, averaging more than 11 times their base salaries. Now, while the absolute percentage of the company owned by insiders is small, the value of these holdings relative to their personal wealth creates a powerful alignment of interests with long-term shareholders.
Because it's a lot of money to them personally.
Exactly. That kind of personal investment provides a strong incentive for management to see the long-term strategy through. Their own financial well-being is tied directly to the company's success.
Now, how a company allocates capital, that's arguably the most tangible expression of its strategy, right? How does IBM's track record look there?
It demonstrates a highly rational and disciplined approach, really mirroring that strategic pivot we've been talking about. In 2023 and 2024, they consistently allocated significant capital towards future growth, spending around $7 billion annually on R&D areas like quantum computing, AI, hybrid cloud.
Serious investment in innovation.
Absolutely. And making 20 strategic acquisitions to bolster those AI and hybrid cloud capabilities beyond just Red Hat, like the recent HashiCorp deal.
So investing heavily in growth. What about returns to shareholders?
Simultaneously, they've maintained commitment there, distributing over $6 billion in dividends each year, which is a testament to their cash-generating ability. And a key indicator of management's disciplined long-term perspective was the decision to suspend share buybacks after the Red Hat acquisition.
Right, that was noticeable. Why was that significant?
Because that move, while maybe unpopular with some short-term traders, prioritized strengthening the balance sheet and keeping a strong investment-grade credit rating over the short-term cosmetic benefit of a higher EPS number.
So long-term health over short-term optics.
Exactly. That's a hallmark of rational capital stewardship. The evidence strongly suggests management is allocating capital rationally and in a shareholder-friendly way. Heavy reinvestment in R&D and M&A, targeting the growth engines. Check. Prudent leverage management post-acquisition. Check. Commitment to a stable, growing dividend, 29 consecutive years of increases now. Check. This coherent approach gives a high degree of confidence in their long-term focus.
Okay, so what does this look like in terms of their actual financial fortress? Let's take a qualitative view first.
Sure. For much of the last decade, IBM's profitability was consistent but definitely under pressure during that strategic overhaul. Revenues actually declined from 2014 through 2021. That was a tough period.
Yeah, lots of headlines about decline back then.
Right. But despite those top-line challenges, the business remained solidly profitable and has been a prodigious generator of free cash flow throughout this period. It shows underlying resilience. Now, the strategic shift towards a business mix dominated by higher margin software and consulting together, making up about 75% of revenue now.
75%.
Yeah, that is structurally improving the company's overall profitability profile, leading to higher margins, more predictable cash flows.
Okay, and connecting this to the key quality ratios, how's their ROIC looking?
Return on invested capital, ROIC, has shown historical volatility. After consistently generating returns well above 20% a decade ago, the metric declined into single digits during the toughest turnaround years.
Ouch.
Yeah. But it has since recovered and stabilized in the 10-12% range. Now, while double-digit ROIC means they're earning returns above their cost of capital, which is good.
Better than nothing.
Right. But it hasn't yet reached those 15-20% plus levels you typically see with a truly wonderful company like a Microsoft or an Apple. The trajectory is positive, indicating improved capital efficiency, but they need further improvement to join that elite tier.
But here's where they really shine, you mentioned. Free cash flow conversion.
Absolutely. IBM is an exceptional cash-generating machine. In fiscal 2024, for example, the company generated $12.7 billion in free cash flow from just $6.0 billion in GAAP net income.
Wait, say that again? $12.7 billion from $6 billion.
Yep. A conversion rate over 200%. GAAP net income, for listeners, is the standard accounting profit on the books.
So they generate way more cash than the reported profit suggests.
Exactly. This consistently high conversion rate, driven partly by large non-cash charges like depreciation and amortization, is a clear sign of a high-quality business model. It produces far more actual cash for owners than the income statement alone suggests. This gives management huge flexibility to reinvest, pay down debt, return capital.
Okay, very strong cash flow. What about the balance sheet strength? You mentioned the Red Hat debt. How does net debt to EBITDA look?
Right. Following that debt finance acquisition, leverage did increase significantly. As of the end of fiscal 2024, total debt was $55.0 billion, cash was $14.8 billion, giving net debt of $40.2 billion.
And EBITDA?
Trailing 12-month EBITDA was around $13.2 billion. So that puts the net debt to EBITDA ratio at approximately 3.0x.
Is 3x okay?
For a stable, highly cash-generative business like IBM, a leverage ratio at or below this level is generally considered prudent and manageable, especially with their stated commitment to deleveraging using that strong cash generation. It provides further confidence in the security of the financial fortress.
Okay, maybe let's quickly run through the trends from 2020 to 2024 just to illustrate the journey. ROI.
Right, return on investment, proxy for ROIC. Moved from a low of 5.38% in 2020, impacted by the Kyndryl spinoff, up to 11.63% in 2023, settling slightly at 10.85% in 2024. Clear upward trend in efficiency.
Great cash flow.
Remained robust. $15.77 billion in 2020, dipped a bit during the heaviest transformation years, but rebounded strong to $12.95 billion in 2024.
Net income
Fluctuated, but landed at $6.02 billion in 2024.
and that impressive SCF conversion.
Consistently over 170%, even hit 561% in 2022, and stayed strong at 215% in 2024. Just highlights that cash power.
And finally, net debt EBITDA.
Remained relatively stable in the sort of 2.6x to 3.0x range over this period, shows disciplined debt management despite the big acquisition.
Okay, that paints a picture of financial recovery and stability. So all of this brings us to the final pillar: valuation, risks, and potential catalysts, where we consider the price.
Right, bringing it all together.
IBM's valuation has really undergone a significant transformation in the market's eyes, hasn't it?
Well, absolutely. For most of the last decade, it was treated as a quintessential value stock, often trading at low double-digit, even single-digit PE ratios.
Deep value territory.
Right. This reflected that market consensus that IBM was legacy tech facing decline or, at best, stagnation. But recently, the stock's seen a substantial re-rating. As of mid-2025, its trailing 12-month PE has expanded into the high 30s, low 40s range.
Wow, big jump.
Huge jump, significantly above its 10-year historical average of around 25. This shift signals the market is starting to acknowledge and price in that potential for sustained growth from hybrid cloud and AI, the narrative shifting from value trap to turnaround growth.
But still below the software giants. Yes, still below Microsoft, for example, which indicates that a degree of skepticism about the long-term growth trajectory persists. The market wants to see even more consistent, accelerating top-line growth before fully buying in.
So how do we define a margin of safety for a company like IBM right now? It's not about buying cheap based on depressed earnings, is it?
No, probably not. It's unlikely to be found that way because the business isn't in a cyclical trough, it's in a structural transformation. So a margin of safety would more likely arise from acquiring a stake in this transformed enterprise at a fair price during a period of temporary and likely overblown market concern, when that lingering skepticism manifests in price weakness.
Can you give an example, scenario?
Sure. Scenario 1. A company-specific but temporary setback, maybe a single quarter of slower than expected software growth, perhaps due to macro factors causing clients to pause big projects.
We saw a bit of that recently, right? Exactly. Recent analyst reports noted such a slowdown caused a stock dip despite an overall earnings beat. That illustrates the point. A long-term investor could use that short-term noise as an attractive entry point if the underlying long-term thesis remains intact and the hiccup is truly transient.
Okay. What's another scenario?
Scenario 2. Market-wide panic. A broad market correction or bear market often leads to indiscriminate selling. Everything gets thrown out. Such an event could provide an opportunity to buy shares in a high-quality, cash-generative business like IBM at a price that fails to reflect its long-term intrinsic value and earnings power.
This brings us to that critical point. Price as the final hurdle. Buffett's advice. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Exactly. Our analysis suggests IBM is well on its way to reestablishing itself as a wonderful company. However, the ultimate return an investor gets is inextricably linked to the price they pay.
Right.
An investment made at a price that already fully discounts a flawless execution of the AI and hybrid cloud strategy will, at best, generate average returns, even if the business itself performs great. The current PE in the 40x range reflects significant optimism already baked in. It demands near-perfect execution for outperformance.
So discipline is key here.
Absolutely. A prudent long-term investor must exercise discipline, waiting for a price that offers a tangible margin of safety. Or the market's short-term anxieties create an opportunity to invest in the company's long-term potential at a more rational valuation.
Okay, let's shift to the growth drivers and the permanent risks. What's the single most important driver for future earnings growth?
It really boils down to the widespread enterprise adoption of artificial intelligence, delivered through a hybrid cloud architecture. The company's entire corporate strategy is pinned on this secular trend.
And financially, how does that show up?
It shows up as continued growth in that high-margin software segment propelled by the Red Hat portfolio and the WatsonX AI platform. Market research from IBM's own Institute for Business Value projects an 8-fold increase in AI-enabled workflows within enterprises by 2025. That points to a massive total addressable market.
Huge potential market.
Massive. Consequently, the rate of adoption and market share gains of the WatsonX platform is the most critical variable for future growth.
Despite this promising strategy, what are the real long-term risks? The things that could permanently damage the business?
Several genuine threats exist. The most significant, I think, is competitive irrelevance. IBM's hybrid cloud and AI offerings could ultimately be outmaneuvered by more agile, innovative, better capitalized competitors, namely Microsoft, AWS, Google.
How might that play out?
Well, for example, if a pure public cloud approach becomes universally dominant, even for critical workloads, or if a competitor's AI platform becomes the undisputed industry standard, if Red Hat OpenShift fails to solidify its dominant position in hybrid cloud, and if WatsonX doesn't gain significant traction, IBM risks being relegated back to being just a provider of declining legacy systems. That would permanently impair its long-term earnings power and render the whole strategic pivot basically moot.
Okay, that's a big one. What else?
Then there's what we call the melting ice cube risk. IBM still operates substantial legacy businesses, particularly in infrastructure beyond the mainframe, and in traditional outsourcing services not spun off to Kyndryl.
Right, parts that are shrinking.
Exactly. A key risk is that the structural decline of these melting ice cubes accelerates faster than the growth of the new AI and cloud businesses. This could lead to a long period of stagnant or even shrinking overall revenue and profits, a situation the company might never escape, even if the new initiatives are successful on their own.
So growth needs to outpace decline.
Significantly. And finally, the failure in the war for talent. Technology is fundamentally a battle for elite intellectual capital. If IBM's cultural challenges that perceived bureaucracy, the impact of frequent layoffs eroding trust, and inability to fully shed its legacy image prevent it from attracting and retaining the world's best AI and cloud engineers, it will inevitably fail to innovate and execute its strategy.
Doesn't matter how good the tech is if you don't have the talent.
Precisely. This would result in a permanent competitive disadvantage, regardless of how sound the strategy looks on paper. Ultimately, people build the products and services.
Okay, those are significant risks. What about potential catalysts? Things that could unlock or accelerate value in the next, say, 1 to 5 years.
Beyond the core long-term growth, I see 2 main potential catalysts. First, the scaling of enterprise AI agents. The successful launch and widespread adoption of AI agents via the WatsonX Orchestrate platform could be a powerful catalyst.
What are AI agents exactly?
Think beyond simple chatbots. These are agentic applications designed to fundamentally re-engineer core business processes, automating complex tasks across an enterprise. As businesses move from just experimenting with AI to this deeper integration, IBM is uniquely well positioned.
So they land big deals here.
Exactly. Securing several high-profile, large-scale enterprise deployments for this new class of service would send a strong signal to the market that IBM's AI strategy isn't just theory, it's gaining serious commercial traction. That would likely prompt a positive reevaluation of its growth prospects.
Okay, that makes sense. What's the second catalyst?
Second, the successful integration of HashiCorp. IBM's announced acquisition of HashiCorp, a leader in multi-cloud infrastructure automation with popular tools like Terraform, Vault, console.
Yeah, HashiCorp is well known in the developer world.
Very well known. A smooth, effective integration that tightly couples HashiCorp's widely adopted tools with Red Hat's OpenShift platform could create a dominant end-to-end offering for hybrid cloud automation.
How would that help?
It could accelerate revenue growth and further widen IBM's competitive moat by making its combined platform an indispensable standard for modern IT operations, simplifying complexity for enterprises across their entire hybrid estate.
Okay, interesting. So let's bring in some second-level thinking. Compare our analysis to the broader market consensus. How does the market see IBM right now?
The current market consensus on IBM can probably be characterized as cautious optimism, or maybe more accurately, a show-me story.
Needs to prove it.
Exactly. Analyst ratings are mixed, leaning positive, but with a wide dispersion of price targets, which reflects a high degree of uncertainty about the future. The general narrative is, the strategy sounds good, but the market's waiting for sustained, tangible proof of accelerating software growth before fully buying into the turnaround. Many are taking a wait-and-see approach.
Do we have any numbers on analyst ratings?
Yeah, just looking at some recent polls. Investing.com, out of 21 analysts, had 9 buy, 9 hold, 3 sell, average target around $281. Benzinga, 8 analysts, 5 buy, 2 hold, 1 sell, average about $265. Webble, 13 analysts, 9 buy, 2 hold, 2 sell, average $281 again.
So a real mix of opinions out there.
Absolutely. It highlights the market's varied perspective and the uncertainty still surrounding IBM's ability to execute perfectly on its vision. There's belief in the strategy, but a healthy dose of skepticism on flawless execution.
Now, here's where our analysis perhaps differs, where we apply some contrarian thinking. How do we see it differently?
We place significantly greater weight on the synergistic power of IBM's integrated business model as a durable and, importantly, underappreciated competitive advantage, that Lollapalooza effect we talked about.
The market misses the synergy.
It appears to. The market seems to evaluate IBM's software consulting and infrastructure segments often in isolation, comparing each to its respective pure-play competitors. This sum of the parts view potentially misses the multiplicative effect of their deep integration.
Okay, so what's the contrarian thesis then?
Our contrarian thesis is that the market is fundamentally underestimating how the combination of these three elements, consulting driving software adoption, software optimized for infrastructure, and the entire stack sold under that trusted brand, creates a powerful flywheel that is exceptionally difficult for specialized competitors to replicate.
Because the competitors lack parts of that flywheel.
Exactly. Pure-play software companies lack the deep consulting expertise. Pure-play consultants lack the proprietary tech. Hyperscalers, while vast, often lack the nuanced on-prem integration capabilities demanded by IBM's core clients. If this integrated model enables IBM to consistently win the largest, most complex enterprise AI transformation deals, the deals needing an end-to-end trusted partner, then the whole will prove far greater than the sum of its parts.
And if that happened?
In such a scenario, the current valuation, which still contains that healthy dose of skepticism, could be seen as quite attractive in retrospect.
Okay, so to summarize the core of IBM's transformation, while the journey is undoubtedly complex, comes with challenges, the underlying thesis suggests a compelling shift. From a legacy giant to a strategic player in critical future technologies like hybrid cloud and AI, it really brings us back to that idea of finding a wonderful company at a fair price.
But despite IBM's clear strategic vision, that strong financial base for its hybrid cloud and AI future, the real question that lingers, I think, is whether it can truly shed the gravitational pull of its past. Can it fully transform its internal culture to consistently win that war for elite talent needed to execute flawlessly? How do you see the balance between its enduring legacy and its future potential playing out in the years to come? That's something for you, our listener, to really mull over.
A provocative thought to end on. Thank you for joining us on this deep dive into IBM. We hope it's provided you with valuable insights and a clearer understanding of IBM's intricate business. Until next time, keep digging deeper.